short-term energy outlook, that's it. Tomorrow is oil stuff, that's it. And then Thursday, it's initial jobless claims. So this number will play a role in what the Federal Reserve decides to do next week. So we're going to pay attention to this. Nothing else really matters in that concept. But what we want to go over to is now that the government has passed, we don't have the debt ceiling, put it that way. They're kicking the can down the road and they just keep spending and spending and spending. Now that they passed this thing, the government has been sitting on the sidelines since January, really not printing any new treasuries. Okay, so how does the government really get more and more money? Well, they issue treasury bills. So they issue treasury bills out to the public and investors. We buy those, and then the government gets that money. Well, since January, the government's been sitting on the sidelines, not selling because of the debt ceiling. Well, now that the debt ceiling has passed and we have more room for the government to borrow some more money, the government's now expected to issue $1 trillion, $1 trillion in treasuries. Okay, so why do I think then mortgage rates are going to go up? Well, let's look at the dynamics behind this. Let me go to my charts here that I use on a daily basis. So here's what you're seeing on the screen. So the treasuries are over here. All right, it says 10-year treasury. Then over here is what we monitor. We monitor the mortgage-backed securities market. Okay, so there's bonds out there that you can invest in. Okay, and these are the treasuries, mortgage-backed securities. There's corporate bonds. There's a whole bunch of bond issuance out there. But the treasury is going to come out and issue $1 trillion of new debt. Okay, that's a lot of debt for the investors to absorb. On top of that, we need them to continue to buy mortgage-backed securities because you need an equilibrium in price and supply and demand. Okay, so let me put this in the context for you. We have $1 trillion more in debt coming out there being issued. So it's flooding the market. Supply economics 101, supply demand. You have tons of supply now. Demand stays stagnant. What happens to prices? Prices plummet. Okay, that's what happens when you have oversupply. When prices go down, what happens to yields? Well, look on this one, the mortgage-backed security bond. Here's what we're looking. The price is 98.23. It's down 0.17. What do I teach you guys on a daily basis? If this number is down, the price of the bond is down, the yield is up. So with this issuance of government bonds going out there, $1 trillion worth, it's flooding the markets with more debt. What's going to happen is the prices are going to drop to absorb that debt, and yields have to go up because of this. So that's a concern of mine right now. So let's get over to what I expect to happen at the Federal Reserve level when it comes next week, because the Federal Reserve's meeting next week, and they're going to determine if they're going to raise rates again or not. So we go to the Chicago Mercantile Exchange. We see this. We scroll down. This is what is the likelihood that the Federal Reserve will change federal target rates at the upcoming Federal Reserve meeting. All right, you go down through here. This is the federal funds futures, which you can see right through here. And let me get my head out of the way, and we're going to look at these numbers. So the futures market's telling us right now that the Federal Reserve is going to do basically nothing at the next meeting. How do we know that? Well, the federal funds rate, which is across through here, is 5 to 5.25 right now. So we're in this column right in here. So there's a 75% probability that the Federal Reserve will not, I repeat, will not raise rates. Why? Because they're saying it's a 24% probability that they're going to raise and a 75% probability that they're not going to raise. But now these numbers down through here between July and the following meeting after that, they're saying, well, there's more than a 50% chance that they're going to raise rates there. So what it looks like, the Federal Reserve is going to kick the can and come back and say, you know, we're going to pause rates right now, but we're going to continue to monitor the markets really tight because we need to catch this. We don't want, and we don't need inflation to run out of control. So that's basically that part of the report.